Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market opens, coming to you every Monday morning at 9 a.m. All the stock market news, trends, strategies, everything you need to be watching for in the weekend to come. And we got a big week coming for you. A lot of earnings coming out this week. Usually doing these as a live stream on Mondays, switching this one to a recorded version. See how you like it. Maybe a little bit briefer, a little bit more concise, and I can still answer your questions in the comments below. So let me know if you prefer the live stream for the stock market news or this recorded version. As I mentioned, a big week for stock market earnings this week. Lots of stocks to watch. We're going to be highlighting 7 stocks to watch this week for their earnings, as well as probably one of the biggest opportunities, I think, in stocks right now. Now you see here the Invesco KBW Bank ETF. That's ticker KBWB. Just an index or a fund of some of the largest banks here in the United States. Plunged 14.5% in April alone. Is really the worst drop since the pandemic crash, and really even since 2008. Wiped out $190 billion in market value. And this performance of these banks, right, really flies in the face of relatively strong environment for profits and Q1's earnings reports, right? We had the financial sectors reporting the second largest surprise in earnings, beating expectations. They're beating expectations by 8.5%. So banks like JP Morgan, like Citigroup, like SVB Financial coming out with their earnings over the first quarter, on average, beating those expectations for earnings by 8.5%. That's the second only to stocks in the materials sector, so second highest. And in fact, Citigroup and SVB Financial both beat their earnings expectations by 41% during their reports. Expectations for full-year earnings out of these bank stocks are still pretty low, with the market forecasting about a 10.7% drop in profits for the group. And now that drop in earnings versus the first quarter of last year is really kind of a little bit of a financial mirage, right? Because what's happening is what we're seeing is a lot of these banks are now taking a lot of money out of their income statement and putting it into kind of a what-if account on their balance sheet. This is called the loan loss provisions account. And really, basically, it's whenever a bank sees possibly a recession or possibly higher loan defaults on the horizon, it's going to take money out of its, before it hits earnings, before it hits profits, and put it in this what-if account, this cash account that says, okay, you know what, if in the future recession does come, or loans do start defaulting at a higher rate, we're going to have this money set aside to be able to cover some of those and not see earnings fall too far from that. We saw this during the pandemic. A lot of banks put billions, tens of billions of dollars aside in this account. That recession never came. So what happened last year? What happened the year before that? They were able to move that money back into their earnings. Resulted in hugely surprising earnings for the banks. Bank stocks were some of the best stocks last year in the market, and I think that's what we see next year as well. If we don't see just a total collapse of the economy, I think you see bank earnings come back very, very strongly. And even if we do see some kind of economic weakness, then the banks are still positioned to do very well in this environment. Through a lot of the bank earnings reports, we've seen the very strong consumer with higher credit spending. JP Morgan reported double-digit increases in consumer credit or credit card spending over the quarter. They also reported higher deposits, which is a little bit weird, that consumers would be spending more on their credit cards, but would also be depositing more into their accounts, in their savings and checkings accounts. It just tells me that people are back out to spending, they're back out to their old ways, but they still do have extra money set aside to put in those deposit accounts. On top of this, then the banks do have that rising rate environment where interest rates are going up, and you know how banks make money, right? They give you pretty much next to nothing on your deposits as far as an interest rate, and then they loan that money out at now at higher rates. So banks are primed to make more money on this environment. Within that, we see the banks, after having sold off for most of this year so far, we see them trading at very attractive valuations, right? Citigroup trades for just 0.54 times on a price to book value. That's the lowest valuation in more than a decade, about half of what this stock usually trades for. So it pays a 4.2% dividend yield, right? So, even if it doesn't rebound immediately, you're going to get that 4% plus dividend yield, and this is in value territory. Even Goldman Sachs, which always trades more expensively than a lot of these other bank stocks, traded as high as 1.32 times book value last year, is now trading at just 0.94 times book value. Okay, so this stock, Goldman Sachs, is trading under book value. Very rare for this stock. Pays a 2.6% dividend yield. So again, even if it takes, even if it takes the better part of a year to rebound on these bank stocks, you're still getting very strong dividends for these value stocks. I want to get to what we're watching for this week because, again, it's going to be a very busy week as far as economic data, as far as stock market data, and some of these stocks to watch in those earnings reports. So I want to get to those. But if you do want to see some of the stocks in my own portfolio, some of the biggest positions in my portfolio, in fact, I put together a report with the Motley Fool. I'm going to link to that in the description below. Click through. It's a totally free report, no obligation. You'll be able to download that free report. It's going to show you the stocks that I'm buying for that long-term growth. This is not some kind of short-term trading idea or anything. These are the stocks that I truly believe in for that long-term growth. So click through that and get that free report. Want to get into what to watch this week in the stock market before we get to those stocks to watch, because like I said, it's going to be a very busy week. The big news is going to come out on Wednesday. The Federal Reserve has its meetings to set interest rates. That concludes on Wednesday, and it is highly expected to raise rates by 0.5%, right? 50 basis points, almost unanimous consensus in the market. And some of those FOMC meeting members have actually signaled that they want to be more aggressive, right? They want to raise rates by as much as 75 basis points, right, or 0.75%. And I think that could spook the market if we do get something like that. But the Fed has been very good at really signaling how much they're going to raise rates, trying not to spook the markets when those rates increases actually do come through. So I do think we get a 0.5% rate increase for this month, and the market is actually pricing in. If you look at the Fed Watch tool on the CME group, then the market is actually pricing in about 2 more meetings of 0.5% increases and even a 75 basis points, so a 0.75% increase in September. So very aggressive increase in interest rates. It's going to keep that uncertainty, going to keep that volatility on the markets because, of course, as we know, as interest rates go up, that's the cost of borrowing for businesses, for consumers. If that goes up too high, it could lead us into a recession. So that's really what the market is worried about right now. We're also going to see the jobs report on Friday. Monthly jobs report comes out first Friday of every month, reporting how many jobs were created in the month before. Now, this month for April jobs reported here in May, we're expecting about 400,000 jobs to be created in the last month. And that would be down a little bit from about 466,000 reported in the month prior, but would still be very high. As far as historical standards, would still be very high, would be consistent with a very strong jobs market. The unemployment rate isn't expected to come down too much. We are expecting more people to come into the labor force that weren't working, so that's going to kind of balance that out. So the unemployment rate is still, though, around historic lows. Job market is very strong. And that's a problem for stocks right now, right? It turns out that good news can be bad news for stocks sometimes. And that's kind of the situation we're in right now, because a stronger jobs market means that the Fed can raise interest rates faster and raise them higher without worrying about destroying the jobs market, destroying about the employment picture. Remember, the Fed has to do 2 things. Only 2 things the central bank is mandated to do. Keep a strong jobs market, right? So keep unemployment low, but keep inflation low as well. Well, right now they're doing a good job at one. Unemployment is very low, down around historic trends. But the inflation rate is skyrocketing, right? So they're really trying to raise rates to bring that down. And if employment stays very good, if unemployment stays low, then they can raise rates as high as they want to destroy that inflation and not worry about the jobs picture. So if we do get a surprise higher number on Friday, which I think there's a good possibility we do, I think there's a good possibility we get a higher than expected jobs number on Friday. That's going to be bad for the markets. That's going to be bad for stocks because, again, it means that the Federal Reserve can raise rates faster than expected. In earnings this week, just over half of the companies in the S&P 500 have already reported earnings, about 55% of those companies. So we're coming into the home stretch for earnings. We've got a big earnings week this week. About 79% of companies in that index, in the broader stock market, have beaten expectations, which is actually pretty typical. And this kind of works into what we're seeing right now. Okay, what we regularly see, especially in this first quarter, is management will come out and they'll try to manage those expectations for the coming quarters for earnings, right? They come out and say, I mean, this quarter was really good, but the rest of the year could be kind of weak. We see all these problems on the horizon. And really what they're doing, it's a game, okay? The management has to beat expectations when they come out because, of course, their pay is tied to that. They have to justify those $1 million paychecks. So they always want to manage those expectations to where they can easily beat them. Again, almost 80% of companies have beaten expectations for those earnings here in the first quarter. And they want to do that in the second and the third and the fourth quarters as well, obviously. So what we see a lot of times, again, is companies coming out, especially in the first quarter, to manage to set those expectations a little bit lower for the rest of the year. They'll come out and talk about all these, negative points that could drive earnings or expectations lower. So as a result of that, I think we are coming up on really kind of the trough of that lowered guidance. What we've been seeing over the past couple of weeks and that big sell-off in April that we've seen is largely a result of management coming out and guiding those expectations lower, guiding that outlook lower. Okay, you see a lot of these companies, they're coming out, they're beating the earnings expectations. They're reporting very good sales, very good earnings, but they're saying, the rest of the year it's looking very weak, and we're going to lower our guidance a little bit for sales growth this year. Okay, and that's brought the stocks down. A lot of these stocks coming down 10, 20%, even 30%, on that lowered expectations. And again, I think we're seeing a trough in that really over the next, week or two. We could see more selling still because of that lowered guidance. But then as we move into, second quarter, third quarter, and fourth quarter, I think you're going to see a little bit more optimism because, again, they guided those expectations lower. The lower expectations for earnings, they're going to come out, they're going to beat them. They're going to say, hey, we were a little bit too negative in the first quarter there. Look how good our sales growth has and pay us our $1 million paychecks. Just briefly, I want to look at what the stock sectors did last week, and then we'll look at some of those stocks to watch on their earnings reports this week. Here we see, again, the sectorspider.com. You can go to that, sectorspider.com anytime and look for this sector tracker. Great resource, great tool to find really that big picture idea of how stocks in the sectors and each sector did over the last week, month, 3 months, 6 months, year to date, all that. And you can see, the sell-off last week. All 11 stock sectors closed lower last week, with even a few of the traditional safety sectors not providing any kind of shelter. Okay, every utility company in the S&P 500 closed lower. Okay, so you got the utility stocks here, generally thought of as those safety stocks, utilities, electricity providers. Is something you have to buy even in a recession. So those cash flows are extremely stable, and they don't generally sell off quite as bad as other stocks. Those stocks sold off 4% last week, actually underperforming the market, and every single stock in that sector closed lower. A lot of that is the fear that inflation is going to be eating into profits for utilities companies. Okay. Companies in the utility sector, they obviously have to get their rate increases approved by state and local governments. And when inflation is running so high, they have a problem passing those costs on through to consumers. So that's a big problem for the utilities right now. Consumer staples, the stocks in the consumer staples sector. So these are going to be all your food processing, packaging, all your household products. And at any time, if you want to see through these, you can click through these and see what kind of companies and what specific companies in the S&P 500 are a part of that sector. Okay, so here you've got, Kimberly-Clark, which makes household products, Campbell's Soup, Brown-Forman, which makes my Jack Daniel's liquor, Hershey's Foods. So you got a lot of food, beverage companies, as well as household products, things that you have to buy during a recession. Can't live without my Jack Daniel's, even during a recession. So I'm going to be buying Brown-Forman all the time, right? So these are typically safer stocks during a recession and, when the rest of the market crashes. And that we saw that last week, down 2% last week. It sucks to lose money, but it's better than losing 3.2% on the rest of the market, right? It's better than losing 7% in stocks in the consumer discretionary sector. So we did see some strength, some safety and shelter from the consumer staples sector. But we are starting to see some opportunities appear. If you look further into these sectors, understand I love to look at these sectors, but they're made up of industries, and sometimes those industries are very different from each other, and can provide very good clues into what to buy and what to what to sell. While the retailers in the consumer discretionary sector, retailers, a lot of those companies that sell things you don't necessarily need to buy, right? You've got, if we click through there, you've got, some of the home improvement companies, you've got toy companies, you've got gambling, things like that, right? Clothes, retailers, fast food, you've got those in there. And while the retailers, some of the restaurant stocks have been hit very hard, sending that sector down 7% over the last week, we are starting to see some strength in the travel and leisure related stocks. We're going to talk about that next with some of these stocks to watch. But we've seen strong earnings out of a lot of these travel and related stocks, especially the hotels, even some of the gambling stocks. You had Penn National Gaming actually closing up last week, which 0.05% up might not seem like much, but it's really good when the rest of the market fell more than 3%. And what we're seeing is a lot of people, credit card spending for travel and leisure was up 69% last quarter, according to JP Morgan data. We've seen Google searches for travel and travel-related websites just surge over the past couple of quarters versus all other, consumer-related searches on Google. So we're starting to see some real strength and consumers coming back to that travel and leisure idea after being locked down for 2 years. And that's something that I think you should watch, especially over the next, for a few weeks or a couple of months. Also, stocks in the financial sector, like we talked about, I think these are some real opportunities here. It's getting very good value territory for some of those bank stocks. Now I want to talk about some of the stocks I'm watching this week. As we said, lots of earnings reports coming out this week that could sway these stocks quite a bit. First on the list is Devon Energy, going to report earnings on Monday after very strong earnings reports out of Chevron and Exxon last week. Okay, Chevron and Exxon last week both came out very strong earnings reports, obviously on those very high oil prices. Couple companies, I think Chevron even said they were going to start increasing production for the first time in years, really. A lot of these oil producers have been really keeping their production lower. Okay, they've been taking advantage of these higher oil prices to get that cash flow going. But they've been worried that oil demand is going to be lower over the next 5 to 10 years. So they're really not spending a lot on new production. That's changing. With these oil prices at $104 a barrel, they just can't resist. So they're going to be increasing production, and that's going to mean cash flow is going to be rising. They're also raising their buybacks, raising their dividends. So these oil companies are just cash flow machines, and it's a trend I think you continue to watch for. So watch this Devon Energy. I think Diamondback Energy, so ticker FANG, also reports this week. Two very good energy stocks to watch. Expedia Group, ticker EXPE, also reports on Monday as well, with analysts expecting a 79% jump in sales to $2.23 billion. Okay, now I highlighted that rise in travel spending when JP Morgan came out with its earnings about 2 weeks ago, and we've seen this play out again over a lot of these travel and leisure stocks. Okay, so JP Morgan reported that 69% jump in credit card spending for travel-related spending. Okay, well above general credit card spending. Google searches, again, for travel-related and travel-related sites jumped over the last couple of quarters. And so I think we're seeing some real strength that isn't priced into a lot of these stocks yet. You could see, Expedia Group was down last week. Over the last month, it's down quite a bit. So I think you've got a good opportunity for some of these travel-related stocks, whether it's online stocks like Expedia Group or even some of the hotels and resorts to surprise on the upside with their earnings. Pfizer ticker PFE reports earnings on Tuesday. It's going to need to show investors that what comes next after that boom in sales from the COVID vaccine, right? Analysts are only expecting $83 billion in sales next year, okay, which is well off from the $108 billion expected this year, okay? So that's about a 20% drop in sales expected from this year to next because of those the COVID vaccine sales start falling off the income statement there. Even on those lowered expectations, though, shares are only trading here for about 3.3 times sales, right? So a price to sales ratio of 3.3 times, which is really a decade low. And these shares do pay a 3.2% dividend, which is very good for drug makers. The company has a strong pipeline. It's one of the best drug makers out there. And what we've seen, actually, I've got a video coming out on Wednesday showing the stocks that did well over the 2008 crash, maybe a little bit of safety stocks, and drug makers were one of those. Drug makers held up very well in the previous recession. So it might be something worth checking out if you're worried about protecting your money, worried about protecting your stocks, your portfolio during the recession. If we get one coming up next year, then the drug makers would be something to do that with. Booking Holdings, ticker BKNG, reports Thursday, along with Marriott International as well, ticker MAR there, and really falls under that same travel-related theme, that we could be seeing a very strong quarter. That's obviously not a guarantee, but the industry has outperformed over the last month with shares of, Hilton, Marriott, Royal Caribbean even, and Booking Holdings here all in the green, over the last month versus that almost 9% loss in the broader consumer discretionary sector. So again, we are seeing a massive sell-off on the consumer discretionary stocks, on those retailers, the clothing makers, things like that. But these travel and related stocks are holding up very well because of those earnings. Shopify, ticker SHOP, reports Thursday as well. Could move double digits either way. This is obviously one of those growth stocks that did very well during the pandemic, has sold off. Stock has already fallen 75% from last year's peak, okay, but still trades pretty expensively at 12.7 times on that price to sales basis. All of you out there in the nation know I've kind of got a limit of 10 times price to sales for the ratio that I'm going to pay for a stock, even if it's a growth stock. The company has been growing its sales at double-digit percentages each year, but that is still very expensive in my book. Company is expected to report $7.7 billion in sales this year, which would be about 30% growth, 33% growth from last year, but management's just going to need to reaffirm that target to avoid a sell-off. Again, like we've seen a lot of these growth stocks, they're still reporting very good strength or very good earnings, very good growth in sales, but they come out with those lowered expectations for their sales growth, and the market just punishes the stocks mercilessly, driving the shares down quite a bit. We saw it in a lot of stocks already. Amazon's earnings last week could be a bad sign. Obviously Amazon and Shopify in that same e-commerce segment. The e-commerce giant reported the slowest sales growth in 20 years. Only up 7% from the same quarter of last year. So, obviously what we're seeing here for these e-commerce companies is the first quarter of last year was very good. We still had some of those COVID lockdowns and that kind of thing. People were still buying online. So growth in sales was very high last year in the first quarter. And of course, it's come down a little bit. It's still up 7% for Amazon, but it also lowered its guidance for the current quarter and on some of those transportation costs, supply chain problems that we've been seeing, and inflation pressures. So all of this is something I think could affect shares of Shopify as well. So you want to watch out there. It's still trading very expensively. It has come down quite a bit from last year's peak. So there could be some kind of a relief rally if it reports very good news or reaffirms that target, that sales target, but it's a little bit more likely that it's going to be warning, just like all of these other companies have. DraftKings, ticker DKNG, reports on Friday as well after selling off just continuously since February of last year. This stock is down now 78% from its peak. Market is expecting about $414 million in sales, or about 32% growth from last year, and $2 billion, $1.98 billion of revenue for the entire year. as with these others, investors are going to need to hear that management reaffirm the guidance. Okay, that's what's most important right now, is that these growth companies, they come out and say, hey, everyone else is lowering their expectations for this year, but we're going to keep ours high. We think we are still going to report those growth numbers. And this is going to be a tough call here for DraftKings, because the market does expect, with that $2 billion in sales this year, that would be a 52% increase from last year. I think DraftKings has a better shot at doing this, at surprising higher than a lot of the other ones. They had a very good Super Bowl betting season in the first quarter, so earnings are going to be very good. What they say about the rest of the year, though, does kind of scare me a little bit. Stock is trading relatively cheap, though, at 4.5 times sales. I think this is one of the best positioned for that increase in online gambling and gaming. I would be buying the shares here. I wouldn't be putting all my money in this, because I think there is still, some kind of a potential for a drop here. But I think this is a great long-term stock, getting into better valuation right now, 4.5 times sales. And I do think they have a better chance than most at reporting a little bit higher sales growth due to that Super Bowl betting and some of the outlook for the stock. Join us every week here Monday for our stock market updates, for all these stocks to watch and the stock market news for the week. Click on the video to the right here, our Friday video, the I bonds. Probably the best opportunity for investors right now. 9% interest rate, going to pay you that on a bond. It's a guaranteed rate from the U.S. government, so you are definitely going to get that rate. Going to give you the protection from the stock market crash as well as from inflation. So check that video out. Again, it's probably one of the best opportunities for investors right now. I invested about $40,000 into it over the last couple of weeks, and I think you should check that out.